So the TSX topping its intraday record. We are joined by Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management. Diana, are you breaking out the champagne over at your shop this morning?
It's too busy. $2 trillion worth of stocks reported today. $2 trillion in market cap. My God, it's very busy today, and thankfully we're reaching new highs on all indices, and thankfully in TSX as well.
Are you surprised that the TSX has been able to do this, given that oil is barely above $50 US?
We had a very good GDP number out of the U.S., and the global reflation trade, as they call it, really rallied oil. Oil was flat today early in the morning when we first woke up. It's now up 2%. That always helps the TSX, Canadian market, really benefits when energy is in play. And we have a lot of global eyes looking at us as it relates to the commodity play in their portfolio. Oil kind of underperformed the industrial commodities. They have taken first spot over the last month, but today's action is really, maybe it's Friday, maybe there's some short covering going on, plus the GDP that came out of the U.S. confirming that things are moving okay on the global recovery front.
Yeah, thanks for mentioning that, because if you look at the the groups, the different stock groups in Toronto, since we got to the previous record high, February 21st, the industrials have been the star. They're up around 13%. Energy is down around 9% since February of this year.
Yes, for sure. And, you know, even in the commodities actually acting a lot better than the stocks. I see today it's a lot better, but if you're looking over the course of the month, for example, you will find and scratch your head why the stocks are not acting as well as the commodity has, say, in the last 2 weeks. So I think it's taken people some time to warm up to the sector. And when we start seeing rotation out of the financials, say, and technology stocks and some of the consumers, it still has been a relative underperformer. So as money rotates, not that it has been down, but it has been a relative underperformer. Portfolio managers can only put their money in so many stocks, so you try to do your top 40 ideas. But as there's rotation and this starts to act better, maybe it receives some money rotate into it. We see in Canada up 4.5%, Suncor up 0.5% today. And despite some of the sell-offs in some stocks, say like Toy down 5% today, our market is still benefiting from this energy and financials rally. When we're working together, it always works well for us.
Actually, I hadn't seen that. You say Spin Master is down today?
Spin Master is down today 5% on Mattel's numbers. Mattel in the U.S. is down. Just looking at my screen, I think it was down about 18% when I last looked at it.
Oh, my goodness.
Yeah, no, it's down 14% currently. Some of it is being blamed by the Toys R Us bankruptcy as toy companies maybe stop shipping to Toys R Us ahead of the bankruptcy protection issues. But really, this has been a Mattel story, and Toy is just Spin Master is actually just a thin stock, only 300,000 shares on a tape. So it tends to be a lot more volatile than it should be.
I know this is always a hard one to measure, but do you get a feeling it's institutional buying has been pushing Toronto higher, or retail enthusiasm?
Actually, volume has been kind of mixed. I haven't seen large blocks, which doesn't indicate that institutional has been higher than it would have been of recent memory. But, you know, blocks don't really trade that much. It's hard to tell in current market structure just by looking at volume what it is. I do think, and I am hearing anecdotally, that there is interest from all aspects of client base, including the non-domestic. That for us would mean probably U.S. But there has been a bit of a pause. Initially, one desk I spoke to initially said that there was more interest, and then as the commodity sold off or did not rally, the kind of stopped moving and there was no interest. I feel that today there's going to be a lot more eyeballs on the sector.
And it's interesting, I'm just looking at new 52-week highs today. I do see two banks there, National Bank and TD Bank, but not all of the banks hitting new record highs today, even though the market has done that.
I'm sorry, you mentioned which one? National Bank. National Bank is trading down about 20 beeps.
Right.
No, they don't. They're not all hitting record highs, but they have done fantastic work over the since the third quarter. Royal Bank is up 50 beeps. BMO's up 10 beeps. CIBC is up 36 beeps. It's okay. You can't all go in the same direction. Sometimes there is rotation. Portfolio managers do sometimes use one bank to sell a little bit of the one bank and buy the other bank as they rotate into what has worked and what has not. I mean, if you look at National Bank chart, it may not be a new high today, but it's only down 20 beeps in the chart.
Sure.
You can see that it has gone from 57 to 62 in about 4 weeks.
Just maybe I could ask the control room to put up a 10-year comparative between our market and the S&P 500. I think it's going to be rather depressing. Sorry about that in advance. But the numbers I've got, by quick calculation via Google Finance, has it that the S&P 500 is up 68% in the past 10 years, whereas the TSX is up a mere 11%.
I hear you. Toronto market is much, much smaller than the U.S. market and a lot less diversified in its company offerings. And so we are so dependent on 2 or 3 sectors working really well. There are some great companies, but as an index, it tends to be the beta that global portfolio managers use in their portfolios. So during the commodity supercycle, Canada was doing fantastically well as global portfolio managers add Canada exposure to their total overall portfolio in an overweight manner. But when commodity supercycle ended, and just normalized, and oil normalized, and all the other commodities normalized, not to mention that it went from such high to $26. I'm not talking about the extremes, just talking about the middle. Unless there is a reason for global portfolio managers to overweight their portfolio in a beta market, it tends to be very, very stock specific.
Diana, thanks so much for joining us at short notice on a historic day with the TSX at new highs. Thanks a million.
Thanks for thinking. Thank you. Bye-bye.
Diana Avigdor. You can see actually over 20 years, Toronto not that much behind the S&P 500. Okay, let's have a look. There you are, over 20 years. You can see really until the recent run-up in the S&P 500, our market was holding in over 20 years. Now, there are the top percentage gainers since the last peak in the TSX, late February. Look at Air Canada. It's been a double. Shopify, still a return of almost 70% despite the sell-off lately after that short report. And Spin Master has been a star as well. And let's have a quick look. We touched on this earlier on the sectors that have been the biggest winners. Industrial strong. I'm imagining that Magna's strength has been a big part of that. Discretionary doing okay. Groceries. Oh no, that'd be retailers. And we're not seeing materials showing up there. Or energy. And in fact, the numbers I have for biggest percentage group moves since the last peak are materials and energy stocks both down 9%.